Good afternoon. This is Tim Legman with BIS Commodities, taking a look at our commodity markets, or our specific commodity markets here in the ag sector in review. Let's start by taking a look where we closed at for the week. December corn, interesting enough, only closed a penny and a half lower in the December contract, just shy of 370 settlement in the D's. January beans only down a penny on the week at 8.86 3/4. December wheat down just shy of 7 cents at 5.02. December cattle down $2.60, 114.47. D's hogs down just shy of 2 1/4, 55.90 again in the December contract. Looks as if oil is going to be down roughly $3 at the time of this broadcast, right around that, flirting with that $60 level a barrel. The dollar a little stronger this week, up 35 points, 96.75-ish right now. Looks like the Dow is going to close with a strong week as well, roughly 700 points up on the week, flirting with that 2,600 or 26,000 level. Taking a look at what happened this week as far as corn is concerned. First of all, take a look at the harvest pace. 76% was reported to us Monday. That's right in line with the 5-year average of 77%. The big news as far as fundamentals are concerned was the weekly supply and demand report. All eyes were going to be on what would the USDA do with the yield projections. The average trade guess was looking for a small cut in yield, and we did get that, and maybe a little bit more. We got just shy of 2 bushels an acre. We were 180.7 last month. We reduced it to 178.9. That was about a bushel an acre less than the average guesstimate. So that was pretty supportive to the corn market. And then on the demand side of the balance sheet, we did see a reduction in export sales and also a reduction in feed usage as well. Export sales down 25 million, feed usage down 50 million. That gave us a carryout of 1.736. That's down from the 1.8 billion bushel carryout the prior month. So looking at all the above, that was pretty supportive of the marketplace, with that stocks to use ratio hovering just above 10% as far as the carryout is concerned. When the computer seen that number initially, we did rally corn. Then we subsequently sold off as more information came out, and that information was world carryout stocks and corn was basically doubled. And this is due to the fact that China this week had gone back and taken a look at the last 10 years of their production, increased their production estimates over that 10 years, roughly 10%. And the USDA had decided to incorporate that into the carryout levels. So stepping back from it, that corn in China is basically an X amount of bushels an acre. China is not going to be in the export and or basically the import business. And moving forward, it's basically going to be our corn. So the things to look at as far as the corn market is concerned in weeks to come is probably on the demand side of things and export sales. We did see we did see our weekly export sales reach the range of expectations this week. When you take a look at it from an overall perspective, we're still well ahead of last year at this point, but we have seen numbers fall off here over the past 4 weeks, and that might be the reflection of why we did see that 25 million cut in exports, as we have been losing some export business for the second half December timeframe to both Brazil and the Ukraine. So that'll probably be the main concern moving forward. Ethanol at this point looks to be on par somewhat with next year as far as demand is concerned, and the feed usage number basically gets figured out every quarterly stocks report. So I think that's the main concern. We'll continue to keep an eye on weather, but it looks as if at this point corn should be harvested in a timely fashion. Taking a look at soybeans, harvest 83% complete on the week. That's a huge jump over the previous week. 89% is the average for this week, so we're still trying to get some catching up to do. We're seeing a little bit of snow here in the Midwest. That certainly is going to make things difficult moving forward to get the last of the beans. The big item there, again, from a fundamental perspective, is the report on yesterday, and the trade was expecting a cut in production numbers, bean yield specifically, and we got that down to 52.1. It's actually bushel an acre less than last month's 53.1, a little bit less than what the average trade guessed, but it was pretty much in line. So we did see the production numbers lower off that. But the surprise, and I don't know if it's a surprise, but we were expecting a cut in export demand as far as soybeans are concerned, and we did get that number coming through, a much bigger cut than probably what the trade had expected, 160 million bushels there. So when we've seen the production decrease 90, we've seen an increase in, or a decrease in that demand, 160 million bushels, that actually raised our ending stock 70 million bushels. So already sitting at a record 885 million bushels last month, we pushed it up to 955 million bushels. So it's something not very supportive, the market, when you take a look at it from that perspective. The big thing moving forward, of course, is the Chinese trade tariff. We did see a couple weeks ago one of President Trump's tweets rallied the market 45 cents in 2 days. So they're still looking at the two meeting, the Chinese Prime Minister and Trump meeting at the G20 summit down in Argentina at the end of this month. That may be supportive moving forward as far as exports are concerned and or the trade tariffs are concerned. But we are seeing an increase again in stocks here, not with the declining yield, not only from a U.S. perspective, also from a world perspective. Now, that being said, the computers sold the market off right away on the open when they read those numbers, but once the selling dried up, we were able to grind back, and actually we did see them close higher today, up 7 cents, and only down for the week. So when you take a look at it from a futures perspective, it's interesting from a weekly perspective that we did not take out last week's lows and we did not take out this week's lows as far as weekly charts are concerned. So it's an inside trading week, and we closed fairly steady from a weekly perspective. So moving forward, the question becomes, one, will some demand begin to show up, even though we've had 4 weeks of poor exports, including a very poor number Thursday morning that's been overshadowed by the report, or is the possibility of a deal in the works? And that's anybody's guess at this point. But I think the thing to keep an eye on continuing is export sales at this point and the relations there. And the other thing is South American weather. We know they're off to one of their fastest starts as far as planting progress to date in Brazil for both corn, first crop corn, and soybeans. So things look very good down there at this point. In fact, they look good enough in Brazil and in Argentina, with any lingering dry spot getting plenty of soaking rain, that the conditions down there can only get worse at this point moving forward. So that's something to keep an eye on. Technically, we're probably still in that $9, $8.40 trading range, and the question is, can we break outside of that range, and what would be the ingredient to break us outside that range? Yet to be determined. So a close above $9 probably would be able to get us a push a little bit farther. It's probably a nice selling opportunity, not only here, but to carry in the market when you can sell that carry out into next spring and summer, and look for better basis opportunities when and if they arrive then. Switching on over, taking a look at the livestock markets. Cattle futures for the week. A little bit weaker. When you take a look at the cash side of things, a little bit cash traded today, 115 Texas. We're seeing some 114 in Kansas. So the South looks as if it's going to trade anywhere from steady to a couple bucks lower. That's in line pretty much where we've seen the futures contract off this week, a little bit weaker as well. Boxes were down for the week as well, down about $2.66, and the choice cutout right at that 216 area. So everything was a little bit weaker this week. But when you take a look at as far as the cash is concerned of the industry, when you take a look at futures, we did take out an area of support on the December charts at that 114. Technically, it looks as if this market could have some more downside in here. The managed funds look as if though they are liquidating their long positions. We've seen that on this week's Commitment of Traders report, that they are continuing to reduce their net longs in the market. Next week, I have to keep an eye on boxes, as Packers are perceived to still be making some very good money, and also keep an eye on some weights out there. We're starting to hear maybe some of these weights are starting to ballooning up on us, so a little concerned that we could be getting backed up a little bit here in the cash side of the business. Hogs down $2.60 this week in the cash. Right around that $57 area as far as the carcass is concerned. Still killing big numbers yet at this point. Weights still comparable to last year, fluctuating up and down, looking a little heavier weights. Exports are fairly on par with last year at this point as well. I mean, the demand is still good, but we're still looking at big numbers coming at us right in front of us here. That'll be the key. We did see the cash back off a little bit this week. We're seeing the futures sell off. The big move was Monday and Tuesday of this week, but we were able to hold those lows in the December contract. So as far as December is concerned, we're right at a line of support here, and it looks as if we're seeing the battle of the heavy fundamentals maybe here in the front term of this thing, and in the next couple months to come, with large numbers coming at us against some money maybe looking to buy hogs due to the ongoing concern of the African swine flu. New cases continue to pop up regularly and or are reported regularly coming out of China. So nobody knows for sure what's going on over there. So you're looking at the perception of that versus the front end supply here. Still continuing to battle it. Take a look at those deferred contracts, still trading over $80 in the summer months. It's certainly an opportunity to protect those levels. But the front end looks like there could be a lot of volatility. I think keep an eye on that $55 mark in these futures. And there's still a gap in the chart clear down there at $50, and keep in mind we are trading at a pretty good discount in the December December hog futures. So we are trading in some lower cash, or at least the futures perspective is yet to come. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.